I think it's safe to say there is one question on everybody's mind right now, and that's whether or not this rally we've seen in the stock market is going to be just another bear market rally, or is this actually going to be the bottom of the stock market? As you can see, this is a screenshot of the market and my portfolio from last Friday. And it's pretty obvious that we have had some pure destruction in all the valuations of my stocks. But it is important to keep in mind that a lot of these stocks rallied over 50% in the past 1 month. So at some point, we do expect for them to cool down. And even when you have meme stocks like Bed Bath & Beyond squeeze and then collapse over 80% in a matter of a few days, you would better expect other stocks to also follow to the downside. But there is some pretty important data that is showing us that this pain will only be short term and that the market has indeed bottomed. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So the first thing I want to address is a trend that I've noticed in the stock market where whenever we see a risk on phase in the general market, we tend to see these meme stocks actually go to the moon and squeeze significantly. We saw this happen with actually every single near-term market top. We saw this happen with AMC. We also saw this happen with something like Coinbase and Rivian in November of 2021. And now it looks like we're seeing this happen with BBBY, which obviously went up over 200% and now has started to collapse. Now, this doesn't mean that the market has topped and that we're going to hit a new low and the pain from June, May, and early April is back. But there are some signs telling us that this is just another pullback and that the market and our portfolios are going to continue going higher. You see, the first and most obvious reason for that is because the S&P 500 has officially rallied to its 50% retracement level from the highs of January to the lows of June. What this essentially means is that on the chart, the S&P 500 has recouped over 50% of its losses that it encountered from peak all the way to the trough. Now, this doesn't mean the S&P 500 has officially bottomed, but historically, every single time this has happened in a bear market, it has obviously always been the bottom, meaning that the market has never hit new lows. What that tells us is that there's a very low likelihood that the market is going to continue crashing and potentially go below this 362 level on the SPY. Now, yes, we could see a pullback, another, let's say 10% or 5% to around this area in the high $390s region. But again, that doesn't mean you just sell and you panic sell. Instead, you should be reallocating your portfolio if you need to raise cash during rallies like this so that you can buy the dip when you actually see those pullbacks. But again, if you want to be a passive investor, I don't recommend you do any of that, and I recommend you just consistently dollar cost average into your favorite ETFs or funds, or even your favorite stock picks if that is your play. And as you can see, right now is historically probably one of the best times to invest in the stock market given the sincere amount of cash levels we are seeing in the market. Every single time we have seen these peaks in the amount of cash levels on the sidelines in the stock market, it has always been a very good time to be an investor, apart from obviously maybe July 2000 and March of 2001. But obviously back then the scenario was completely different because back then we were having a broad bubble actually pop, whereas this time we're simply seeing a short-term inflation spike all of a sudden result in an aggressive Fed, which is raising interest rates and bringing down most tech valuations. But again, this shows you that you're getting a good time to buy right now if you're a general investor in the stock market. And following that, another question many people have been asking is whether or not inflation can actually come down without a recession. And unfortunately, as you can see, this data shows that for inflation to go down from 9% CPI to the Fed's target of 2%, it is unfortunately going to take a recession for that to happen. But the question is, how big of a recession is that going to be? I think recession is an extremely overused term in today's social media, and there's a lot of YouTubers creating videos around recession, which has become this hot buzzword attracting a lot of clicks. But the reality is that we're already in a recession because of 2 quarters of negative GDP. But I'm sure if you're the average consumer, you're probably not feeling this as a recession because you probably still have your job and you're probably still out there spending money and your nearest restaurants and small businesses are still open. That is not an actual recession, guys. This is not 2008 or even the end of 2001. This is a simple technical recession, which means that technically speaking, we have the ingredients in place to bring down inflation like we've been talking about for the past year or so. Yes, we're going to need negative GDP or reduce aggregate demand to bring down inflation. But I don't see why that is a bad thing because obviously inflation is significantly bigger of a concern to the Fed right now than causing a light recession, which is obviously the main thing the stock market cares about in the short term. And as you can see, the reality is that you are getting a pretty good deal from a PE ratio metric as well on the S&P 500. We have come significantly lower from the overvalued nature of the market from back in 2020 and 2021, which obviously equaled the dot-com era of valuations. As you can see now, the valuations have come down to right around that 2004 era and the historical average, which is sitting right around the $16 level. And this is only in the large cap sector, meaning these are companies in the S&P 500, not in the S&P 600 or the S&P 400, which are the small and mid-cap companies, which are mostly what I invest in. Those valuations have come down even more significantly lower, and they're actually trading at around this level compared to the all-time highs. And that is something I think many people are simply not pricing into this market and are just buying into a lot of the fear and the FUD we're seeing about this recession and the stagflation and the Fed being extremely aggressive, which again, I simply don't see happening because obviously they realize a lot of this inflation is only being driven by short-term headwinds like China's supply chain bottlenecks. People need to realize that this inflation is driven by a pandemic, not a system-wide problem. It is literally driven by excess demand, which is obviously a good thing in an economy. You want to see people spending money. But at some point, if it gets too overheated, then you need to see a cool down. And that is simply what we're experiencing right now in the market. So if there's ever been a time to be a buyer of stocks, it's during times like this when you're simply seeing a cool down in a very hot economy, because that guarantees you that in the long term, you're buying a very strong and stable economic condition, which obviously is going to benefit the revenues and profits of any of the tech companies or engineering firms that you're buying. And obviously, for me at least, most of my portfolio is focused exactly in the tech sector. And I've said this time and time again, we are still seeing most risk assets signal the bottom has already happened. The XPEV ETF has rallied over 20 to 30% from its lows, and even after this massive red day we were seeing on Friday, the market has still not come down any significantly lower from its all-time highs. It simply looks like a pullback in the short term, and the volume that this ETF is trading is significantly higher than any previous time over the past couple of years since 2020. And so what this generally shows us is that people are starting to find value in small companies, which means that the risk appetite for the stock market is slowly starting to go up. And the best part is that this rally right here is actually being accompanied by a lot of breadth, meaning that we're seeing all companies in the S&P 500, from consumer cyclicals to discretionary companies to even the tech sector, actually rally with the S&P 500 to the upside. It wasn't just a tech-driven rally. You see, a lot of people have been making comparisons to the rally that we saw here in March, which obviously ended up being a fake rally and trapped a lot of people who bought at the top. And the market obviously continued down significantly lower all the way to these June lows. But the difference is that this rally is not only significantly more sustained and has lasted a longer period of time, but it has also been accompanied by a lot of breadth. As you can see right here, the percentage of bullish stocks in the tech sector and the IT space has been basically hitting all-time highs. And that is with the market also hitting a near-term peak. And by far, the best part about this is that most asset managers are still net short the market right now. And although people say you want to follow the big money, in this case, historically, it's always been a bad time to follow the big money. Because as you can see, every single time this index has hit this bottom level, the market has always rallied. Essentially, this shows us that there's a short squeeze happening when all these fund managers are forced to cover their positions as the market goes higher. And again, that is just simply adding to my own conviction in the stock market having bottomed and me continuing to buy the dip anytime my stocks go down, anytime significantly. But as usual, guys, make sure to drop me a thumbs up, and I'll catch you guys in the next video. Take care.